the Market Gauge Group Managing Director Michelle Snyder, along with Key Advisor Group CEO Eddie Gabor. All right, Michelle, it's official. Wall Street has written off tech names. Any mega growth stock, they say get rid of it. Why are they wrong?
Well, of course, Wall Street and hyperbole never goes together, right? So I wouldn't exactly say get rid of it, but I would definitely get out of the way for now. And that's because we're seeing really two major happenings right here in most of the mega cap names. One, they're in caution phases, and I take that word seriously. That means they're trading under the 50-day moving average. And two is the momentum in terms of the velocity of the price movement is declining. So that tells me right now is not the best time to buy. Maybe we'll see another flush. And if you want to look at one mega cap, the quintessential, then look at Apple, which right now is sitting right above its 200-day moving average. If that breaks 217, it's trouble. If it trades between 217 and 225 chop, takes out 225, then I would say, yeah, it's time to get back in.
Write that down, folks. 225 is your buy signal. Eddie, I know you like big tech too. Is this the buying opportunity? Are you holding? How you weathering the storm?
So we are definitely underweight tech, as I shared a few weeks ago, but I still think you cannot abandon it. My two favorite in this space right now would be Google and Microsoft. I still think those are good buying opportunities. But look, we're going to be in this inflationary and rising interest rate market environment for the next few months, so they're not going to get the upside that other sectors are. But to completely abandon it and say to abandon those companies, I don't think is very prudent.
Yeah, I think you'll regret it before the year is over, before the next year is over, and the next year, the next year, the next year. Hey, let's switch gears, though, because now a lot of folks love financials and love it even more after last night. The Fed going to allow these big banks now to resume those big dividend payments. Eddie, you buyer of any of these big banks?
I am. I do like the banks here. It's been a while since I've liked the banks because they've given us head fakes before in the past. But I think it's crystal clear right now, in our opinion, that the 10-year note's going to head to 2% some point in time this year. And the Fed is committed to keeping the short end of the curve low. So that steepening of the yield curve is very positive for the banks. Plus, with what we expect from the consumer, these banks that have a lot of customers on the consumer side should be very, very profitable here over the next few months for those that are getting into the bank. So I am a buyer here.
Michelle?
Well, I agree with Eddie a lot. Obviously, the whole market has to hold up. That's going to be a part of it. And I am concerned, is what I said before, about the momentum across the board. But in terms of banks itself, we like Wells Fargo, actually. I looked through all the big banks. We already have a position, and so I'm not speaking my position. I'm saying even in general right now, that has a lot of potential to the upside. So put some numbers on it. $37 is your risk. And I think now if it closes over 40, you have a lot of upside. Could see up to about $48 at least. So that's what we're watching for right now.
So at least 20% from the breakout. Hey, the stealth rally in industrials and materials, two very boring sectors now tripping off the lips of everyone now. But it's been remarkable, and of course, next Wednesday, President Biden's going to unveil his infrastructure plan. Michelle, how much exposure do you have with these sectors?
Well, we have a little bit of exposure right now. We're long a floor construction company, but looking at that stimulus that infrastructure package, I have some doubts about it because it's got a lot of other things in there besides infrastructure. And as much as we all know that we need to pass a package, when you're throwing free community college in there, it makes me a little bit worried about getting some kind of a bipartisan agreement, especially when we're talking about taxes as revenue. But with that said, I do like a few things. Vulcan Materials looks great. Floor construction looks great. And also 5G, which is part of the package. You could look at American Tower, AMT. That also looks like it's about to take off. It actually triggered a buy today.
And for those listening on radio, the other two symbols are FLR. And what else do you like? Oh, BMC, Vulcan. Hey, all right, so I talked about the stimmies, right? They're out there. They're making their ways. It's going to be a beautiful weekend in New York. I'm going to see the money spent firsthand on the field trip. Bank of America said at the end of March 20th, the average spending on home categories up 97.9%. Eddie, how do we take advantage of that? How do you invest in something to take advantage of that? Because I think it's amazing.
Look, this is going to continue, in our opinion. We've been saying this and pounding the table on the fact that the consumer spending numbers, in our opinion, are going to be the largest that we will see in our lifetime. So this is all inflationary. So you want to be overweight anything that's tied to inflationary, okay? So you want to be oil, energy, financials, industrials, and I'll throw retail into that space as well too. And so I think we're going to see this massive boom on these higher risk assets over the next 6 months. No, everyone keeps doubting this rally. The VIX is breaking down. We said several months ago we thought the VIX would get into the mid-teens. It is lining up to have some massive profits for these companies. The VIX is going to head to the mid-teens and lower, and I think we'll be well above all-time highs when I'm sitting here in August.
Yeah. The so-called fear index is not showing any fear at all. Michelle, real quick, do you have a retail name you like? Anything consumer discretionary?
I think you should be looking at Whirlpool. It's a different aspect of the consumer, certainly home improvement, and it's also doing very, very well. It just sort of broke to new all-time highs, but the risk is still very manageable if you just